My name is Ashutosh Kumar, and I am a team member of the Center for Content Creation at NISM. The National Institute of Securities Market is a public trust established in 2006 by the Securities and Exchange Board of India, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards in securities markets. As parts of its capacity building initiatives, NISM also offers a bouquet of 60 plus online self paced e learning programs, including skill development modules. These range from basic financial courses in English and vernacular languages to specialized niche courses on topics spanning investment management, fixed income, equity derivatives, ESG, wealth management, forensic investigation, anti money laundering, securities law, broking operations, and many more areas related to Indian securities market. The courses can be accessed through NISM Learning Management System at online.nism.ac.in. Now, I would like to request Mr. Onkar from our marketing team, who is going to give the glimpse of our e-learning course via video. Mr. Onkar, please.
Your career feels stuck. You're waiting for that perfect opportunity to come along. But here is the truth. Opportunity isn't something you wait for, it's something you build. Welcome to NISM e-learning, where your financial career takes flight. We are NISM's online learning platform. Whether you are starting fresh, switching careers, or sharpening your edge, we are here for you. Quality education, affordable pricing, zero barriers. No matter where you are or when you learn. Industry designed courses from securities market veterans with decades of real-world expertise. From foundational financial literacy to specialized expertise, equities, mutual funds, derivatives, compliance, risk, wealth management, and beyond. NISM e-learning course covers securities markets areas comprehensively. This includes topics related to mutual funds, financial planning, SME listing and compliance, forensic investigation, anti-money laundering, and more. Every course is built with leading knowledge partners and academic experts, thoroughly vetted and constantly updated. Your journey starts now. Visit online.nism.ac.in today. Learn at your pace. Learn on your time. NISM e-learning. Build your future.
Thank you, Mr. Onkar. Now, NISM also performs two functions delegated to it under the Securities and Exchange Board of India CAPSM Regulations 2007. CAPSM stands for Certification of Associated Persons in Securities Markets. They are offering mandatory certification examination for associated persons in the securities market intermediaries, offering continuing professional education programs for associated persons in the securities market intermediaries. Upon expiry of the validity of the certificate obtained by an associated person, the certificate shall be revalidated by passing the relevant NISM certification examination before the expiry of the existing certificate or by successfully completing a program of relevant one-day continuing professional education as may be specified by NISM during 12 months preceding the date of expiry of the certificate. NISM issues certificates through DigiLocker. The certificate will be revalidated for a period of 3 years from the date of expiry of existing certificate. You can visit nism.ac.in/certifications/ to explore more about it. The topic of today's webinar is Equity Derivatives Fundamentals, which will focus on our e-learning course and certification in the equity derivatives space. I would like to take this opportunity to introduce our guest speaker, Mr. Vijay Kanchan sir today, who will take the session. Mr. Kanchan is an adjunct faculty at NISM. He holds a postgraduate degree in finance from JBIMS and is certified in various NISM modules, including equity derivatives, currency derivatives, fixed income securities, research analyst, and investment advisor. With over 30 years of experience in capital markets, he has held leadership roles in institutional derivatives at top broking firms and brings expertise in areas such as institutional dealing, derivatives research, proprietary trading, and depository operations. As a adjunct faculty member and visiting faculty member at esteemed management institutes such as NMIMS, NL Dalmia Institute of Management Studies and Research, XLRI Jamshedpur, and KJ Somaya Institute of Management and Research, Mr. Vijay has regularly taught core finance subjects including derivatives and risk management, fixed income securities, international finance, forex markets, financial risk management, and corporate finance. Mr. Kanchan has trained over 8,000 market participants as an NISM in panel CPE trainer and has conducted MDPs for organizations such as SEBI, SBIMF, ICICI Bank, and Axis Bank. He is also a visiting faculty at several leading management institutes across India. Mr. Vijay Kanchan sir, over to you.
Thank you, Ashutosh. Thank you for that kind introduction. Participants, are you able to hear me clearly? Can you please respond? Is my voice coming across clearly? Okay, thank you. Yeah, let's begin with the derivatives. Before I start this, just let me briefly take you to some events in history. It was the collapse of the Bretton Woods system in the early 70s. Bretton Woods system was formed during the end of the Second World War, where dollar became the reserve currency of the world. It was linked to gold, and the other currencies were linked to the US dollar. But what eventually happened was rising budgetary deficits, including a war with Vietnam, would eventually force US to disband this system. So in 1971, the then President Richard Nixon suspended the gold convertibility clause in the US dollar, as a result of which the currency markets became very volatile. So the financial derivatives actually evolved due to what was happening in the currency market way back in the early 70s. Two important events would take place in 1973. For the first time, equity options were allowed to be traded in the stock exchange. That was the CBOE, the Chicago Board of Options Exchange, allowed equity options to be traded in 1973. Uh, a famous paper on options or the pricing of options, the Black and Scholes pricing model, was published in 1973 by two economists working together, Myron Scholes and Fisher Black, and simultaneously one more economist by the name of Robert Merton. He also came out, published a paper on the pricing of options. These findings were combined. This model today is known as the BSM, Black, Scholes, and Merton model. It is widely used all over the world to price options. So that is how the markets evolved. A lot of innovation was happening in the developed markets. Rapid advancement in technology, new financial products. The financial markets was now attracting the best talent from all over the world. So a combination of all these would lead to an exponential growth in the derivatives market, particularly in the 80s and 90s. In India, SEBI, sometime in the mid 90s, seriously looked into the possibility of introducing derivatives in India. So there were two committees which was formed. One was the J.R. Verma committee report and the L.C. Gupta committee. SEBI would accept almost all the recommendations made by this committee and derivatives was officially launched. Equity derivatives was officially launched in 2000 in India. We began with the index future in June 2000. We introduced index options in July 2000. We introduced stock options in March 2001, and we introduced stock futures in November 2001. The markets have grown by leaps and bounds, and the average daily turnover, especially during the expiry week, can be anywhere between 1.5 to 2 lakh crores per day. So it's one of the biggest markets in the world. Okay, so that is a brief introduction on derivatives. So let us try to understand what exactly is this product. Give me a minute. I'm just opening the presentation. Just a minute. Uh, are you able to see my presentation? Can you please confirm?
Yes, sir, we can see your screen.
So basically, what are derivatives? I think most of you know the definition of derivatives. These are financial contracts or instruments whose value is derived from some underlying asset. Okay, so by itself, the derivative would not have a value. It is a derived value, and that is why they are called as derivatives. Now, what are these underlying assets? Uh, in the times in which we live, you can have a derivative product on practically anything that you can think of, anything in the world, where the prices keeps on fluctuating. It's possible to have a derivative contract. So some famous underlying which are commonly used. So it could be your gold, silver, aluminum, copper. So most of the metals, there is a derivative contract which is available. Energy sources, like crude, for example, crude contract is one of the biggest in the world. You have derivative contracts on electricity, natural gas, coal, etc. You also have derivatives on most of the agricultural products like wheat, coffee, pulses, rice, etc. And of course, the financial derivatives, which is one of the biggest markets in the world. You have derivatives in equities, equity indices. You'll have derivatives on the treasuries, bonds, tables, etc. And you also have derivatives on the currencies, which is the foreign exchange market. Right. Good so far. So we can broadly classify derivatives. These are the four major classification as a forward, a future, an option, and swaps. We will not be covering swaps today because it's a completely different type of a product that would need a detailed explanation. Won't be possible to cover that in such a short time. So today I will focus more on the forwards, the futures, and the options. Now, what are the reasons which have led to the growth of this market? I mean, why do we need a market like this? So one is, which I mentioned earlier, increased volatility or increased fluctuations in the underlying asset prices. Most markets today, they are linked globally. They have become integrated. So any event affecting one, market somewhere in a different geography, the ripples are felt everywhere. So an event happening in one country can impact the global markets almost anywhere in the world. We have seen a huge growth, in telecommunication, in technology. So this has actually, brought down the computing cost. So the markets today are linked electronically with each other. So this has significantly brought down the cost of, doing any transaction. Transaction cost has significantly come down over the years. Uh, you have a lot of sophisticated players trading this market. The markets have attracted the best talent from the top universities all around the world. So you have players, small, big, large, sophisticated players trading this market. Uh, and you have seen so much of innovation happening, new products, both in the actual derivative market, in the fixed income markets, a remarkable growth in financial innovation. So a combination of all this has made these markets very big. So I'll give you a perspective. Uh, the total outstanding in derivatives at any point of time in the world is close to about 750 to 800 trillion dollars, which is nearly 7 to 7.5 times the world GDP. So that is the size of market we are talking about. Uh, Let us try to understand what exactly is a forward contract. So this is the most basic of all derivatives. Is a very simple derivative instrument. A forward contract, I can define it as a customized contract between two parties, two entities, where all the terms and conditions are decided today, but the actual settlement will take place sometime in the future. So this is the very nature of a forward contract. I can also say that it is a private contract. It is a bilateral contract, uh, normally between two institutions or between an institutions and one of its client. The uh, How do you differentiate a forward contract from others is a forward contract is a OTC product. It is an over the counter product, and your forward contracts are normally not traded in the exchange. So this is what differentiate a forward contract between, with the other derivatives. So how is a forward contract structured? So both the parties in a forward contract will take opposite position. So one will be on the buying side of the contract and the other will be on the selling side of the contract. The one who is on the buying side, we say that he has a long position. And one who is on the selling side, we say that he has a short position. So when you're on the buying side of the contract, it is said that you're long the contract. When you're on the selling side of the contract, it is said that you're short the contract. So these are typical derivatives terminologies. Uh, the one who is on the buying side, he will agree to buy the underlying on a given future date at a specified price. The price has already been decided today. And similarly, the one who is selling the contract agrees to sell the underlying on a given future date, at a specified price, which has already been decided today. Both the buyers and the sellers have the obligation as well as the rights. What is the meaning of that? The buyer will get the benefit if the prices goes in his favor. Uh, he is obliged to honor the contract if the price goes against him. Ditto, the same is applicable to the seller. He will get the benefit if the price is correct. He will make money that way. And similarly, if the prices goes against him, he is obliged to honor the contract. So, in the language of the markets, we say that both the buyer and the seller will have the rights as well as the obligations when they trade the forward contract. Let us understand with the help of a simple example how this actually works. Let's have a look at uh, two banks, Bank A and Bank B. They have entered into a forward contract. So Bank A agrees to buy 10,000 US dollars at the rate of 95. This was the price which was decided from Bank B. And after 2 months, what will happen is Bank A will get his $10,000 and he will end up paying 9,50,000 rupees. This is at the rate of 95 to Bank B. So Bank A will get $10,000 by paying 95, irrespective of whatever is the then prevailing price. So even if the price is 97, for example, Bank A will get his $10,000 at the rate of 95. In other words, Bank B is obliged to give $10,000 to Bank A at 95, no matter whatever is the price at that point of time. So that this is how a contract is settled. Let's take two examples. Suppose at the time of settlement, the USD INR is 95.50. So what has happened is Bank A has made a gain of about 5,000 rupees. This is the price difference into 10,000. And the same amount will be a notional loss for Bank B. I hope you understand this example. Similarly, Bank B will gain about 7,500 rupees on this transaction if the USD INR is 94.25 at settlement. So this is the difference, and this is how I've calculated. I hope you have understood this example. So this is typically how a forward contract will get settled. Is this clear to all of you? Shall I go ahead? So in the example which we have taken, Bank A has a long position, or we say he is long the forward, and Bank B has a short position. Bank B is short the forward. Now the forward contracts have been used very extensively in the FX markets in India, uh, where you have the commercial banks, you have importers, exporters, you have the large institutions, including the central bank, who are major participants in this market. So the forward market in currency is very big. Uh, the beauty of trading a forward contract is because it is a OTC product, it gives you tremendous flexibility in designing. Flexibility in terms of price, in terms of quantity, quality. Quality is applicable only for commodities, not for the financial instruments. The delivery time and place. So that makes a forward contract very attractive to the participants. Okay. Let me take one more example. So you have a farmer who is expecting his harvest after 2 months. So assuming he's taken care of all the other risk, then the biggest risk a farmer carries is the price risk. That is, after 2 months, the price of the wheat coming down. So what should he be doing? He should be selling wheat 2 months forward. So suppose he agrees into a contract with, baker. Now for baker, the risk is the wheat price going up because wheat is a raw material. So this is the price they have agreed. The farmer agrees to sell 10,000 kg of wheat 2 months forward at 52, and the baker agrees to buy a 10,000 kg of wheat 2 months forward. So this is how a contract would look like. Now, assuming this is a forward contract and there is no intermediate party involved, what will happen is if the price goes up at the time of settlement, the farmer can change his mind and is likely to default. So there is a counterparty risk involved here. And if the wheat is trading at about 30 per kg, it's likely that the baker would default, because why would he otherwise pay 52 per kg as decided in the forward contract when he can get wheat at 30 per kg? So this is the biggest issue with the forward contract. Each party is exposed to a counterparty risk. Secondly, once having entered into the contract, if the farmer has a change of mind, he is not likely to get an exit route, because he'll be at the mercy of the baker. And the same thing is applicable to the baker. If he has a change of mind, he is unlikely to get an exit route. So, because of issues like this, your forward contracts suffer from poor liquidity because they are customized. 10,000 kg of wheat in this example, which we are taking, would not be of much interest to many people out there. And because the liquidity is poor, the price discovery mechanism. Price discovery happens because of the continuous actions of buyers and sellers. It's basically nothing but your demand and supply. So a price discovery will be very poor in the forward contracts. Now, because of all these reasons, eventually the futures came into existence. Now, let us try to understand what exactly is a future contract. Futures are significant improvement over the forward contracts. They are almost similar to a forward contract, but with a key difference. They are traded in the recognized exchange. So when the exchange comes into the picture, we will have a clearing corporation. So what will now happen is the counterparty risk is taken care of by the clearing corporation. The clearing corporation guarantees all participants that their trade will be settled. And because an exchange is involved, most of the future contracts are standardized, they're not customized. So it attracts a lot of participants. I'll give an example. If you're trading Nifty, for example, in the NSE F&O market, the lot for Nifty is 65 shares. So you can trade in 65 and in multiple of 65. Uh, Once having traded a futures, if you have a change of mind, you can exit the contract any number of times. No one can stop you. So because of all these reasons, the sheer size of the market, lower transaction cost, your quality of participation, uh, then your ability to leverage, ability to go long and short, which is available to you in the futures market. So whenever a news, good news or bad news hits the economy, the future markets will react very fast, instantaneously to all such information. So the price flow through the system is very rapid. They in turn will influence the underlying stock market, equity market, leading to an efficient price discovery mechanism. Okay. So this is how it would look like if the farmer and the baker, if they were to trade in the exchange for the same contract. This is how it would look like. There is going to be a clearing corporation who will be in between. So if the farmer is the seller, the clearing corporation becomes buyer to the transaction. If the baker is the buyer, the clearing corporation becomes seller to the transactions. In fact, the clearing corporation becomes a counterparty to almost each and every trade that happens in the exchange. This process is called as novation, is a very important concept in settlement. Novation will ensure that all the trades are settled. So this is what I was talking about. That when you trade in the futures market, your trade is guaranteed by the clearing corporation, and it will be settled by the clearing corporation. They do this by collecting margins from all the participants. So there is no question of default. Right. This is what I mentioned. The clearing corporation becoming a counterparty to all the trades in the exchange through a process called as novation. So because of novation, uh, this will eliminate the risk of a counterparty default. And now, since a lot of entities are involved, many participants are involved, the markets are very liquid. and the price discovery mechanism becomes very efficient in this. Uh, why do we need such a market? The economic rationale of having a derivatives market. Uh, one reason is price discovery, which I briefly mentioned now. This will attract, a lot of sophisticated investors, investors with better judgment and information, large players. The flow of information through the system is very fast, and the markets react immediately to whatever is happening in the economy, globally, domestically, in the financial markets. The transaction costs are much lower compared to your equity transaction or a forward market transaction. And because of a combination of all this, the price discovery mechanism is very efficient. Secondly, risk transfer. In a way, the derivatives market works like a giant insurance company. Uh, any market will have two types of participants, investors who are risk averse and investors who are willing to take risk. So, what these markets do is they redistribute risk. Someone who does not want to take risk can transfer his risk to someone who is willing to take risk at a very small cost. So it gives opportunity to everyone, those who want to take risk and those who are a little averse to taking risk. So the risk is distributed uh, in the system. Lastly, given any state of economy, given any state of the market, it is possible to create or design products that will help you participate in the market. For example, when you're trading equity, you will only benefit if the economy is doing well, because then and only then the markets will do well and the companies will do well. The same is not the case with the derivatives market. You can go long in the market, you can go short in the market if you have a bearish view. Even if the markets are sideways, options can help you make money. If the markets are volatile, options can help you make money. And you may have a crazy view. Yeah, I am bearish this month, but I'll be bullish next month. It's possible to create a product. So that is why they often called as complete markets. Okay. Uh, So with this, we have covered the forwards and the futures and the basics of derivatives. I'll now come to the options part, and the last 10 minutes will be a question and answer sessions. If you have if you're having any doubts, please keep your questions ready. So, what exactly are options? They are also derivative contracts, uh, quite unlike your forward contracts or futures contracts. They're completely different. So, if you are a buyer of option, you have the right to either buy or sell a given quantity of the underlying asset uh, at a price which is decided today and up to a specified date, because all these contracts have a maturity period. So till the maturity period, you have this right either to buy something or to sell something. So options have an unsymmetrical payoff profile because they are not like forwards or futures. Here, the risk and reward will be different for a buyer and it will be different for a seller. Recollect, in a forward contract or a futures contract, the buyer or the seller carry the same amount of risk. But it is not the same with options. In options, the buyer has a limited risk and a potentially unlimited profit, whereas the seller has a limited profit and a potentially unlimited risk. So buyer of option will have the right of exercise. He does not have the obligation. If the price goes against him, he will let go the contract and he will lose only the premium amount. He will not be forced to buy the contract. The seller of the obligation the seller of the option has the obligation to honor the contract whenever it is exercised. The seller has no right. So, in a way, the relationship is not equal. I'm repeating it. The buyer has a limited loss and an unlimited profit potential. The seller of the option has a limited profit and an unlimited loss potential. So let's understand two major products, the call option and the put option. So what is a call option? Call option gives you the right to buy a given quantity of a particular asset at a price which is decided today, and you get the right to perform this contract on or before a specified future date. The buyer has no obligation if the price do not go in his favor, so he will let go the contract. In order to acquire this right, he will have to pay a premium. Okay, and because his losses are limited, he will not be required to pay any margin to the exchange because the risk in his position is very low. Fine. I'll give an example. You bought a Tata Steel, let's say 220 call, and you paid about 3 rupees. And let's assume Tata Steel is trading at about 218, 219. You believe Tata Steel will go up. Now, what happens is your view went wrong, and Tata Steel corrected badly to, let's say, 210. Now, you don't have to incur the loss from 218 to 210. What will happen to your position? You paid about 2.5 rupees to the option. You forego the option amount. So this is how call option will function. Let's have a look at the call option. Seller, he has an obligation to sell a given quantity of the underlying asset at a predetermined price on or before the maturity date. The seller has no right. Okay, and if the price goes in his favor, he will not get the benefit. He will only get the premium amount. And because this risk is undefined, he will be margined by the exchange. So let us take the same example. There was a buyer who bought Tata Steel 220 call option and he paid about 2 rupee 50 paise. So obviously on the other side, there will be a seller who received 2 rupee 50 paise. Now, if Tata Steel corrects from 218 to 210, the seller will not get the benefit. He will only get 2 rupee 50 paise. But should Tata Steel go to 240, the seller will be obliged to sell Tata Steel at 220. So that 20 rupees loss he will have to bear. So this is the difference between option buying and option selling. Let's have a look at the put option buyer. A put option buyer has a right to sell. Okay, a put option buyer has a right to sell a given quantity of an underlying asset at a predetermined price on or before the expiry date. The put option buyer has no obligation to sell if the price does not go in his favor. In order to get this right, he will have to pay a premium. Just like the call option buyer, the put option buyer will not be margined by the exchange because the risk in his position is very, very limited. So let me give an example. Let's take a stock like State Bank of India. Let's assume State Bank of India is trading at about, maybe about uh, 900 rupees. You bought the 900 put option and you paid about 7 rupees. What is your view? Your view is the markets are bad. State Bank of India will correct sharply. Suppose it does not happen and State Bank of India continues to move up, you will lose only 7 rupees on this trade, nothing more than that. But if State Bank of India corrects from 900 to let's say 800, you'll get 800, 100 rupees on this trade because you have a right to sell at 900 rupees. So that is how a put option works. Let's have a look at the seller. The seller has the obligation to buy a given quantity of an asset at the predetermined price on or before the maturity date. He has no right. Okay. An option seller in general will not have a right. They will only have the obligation. So he will have no right. I'm taking the same example of State Bank of India. So there was one trader who bought the 900 put option at by paying 7 rupees, which means someone would have sold the option at 7 rupees. So who is a put seller. So now what will happen here is if State Bank corrects from 900 to 800, the put option seller will lose 100 rupees. That's of course the premium amount which he has received at a net level. But if it does not correct and it goes from, let's say, 900 to 1000, the put option seller will not make 1000 rupees here. He will only make 7 rupees. So the seller makes only the premium amount. He cannot make more than the premium amount. But if the market goes against him, he can lose a lot of money. So a seller will always receive the premium. The buyer will always pay the premium. And because the seller's position is considered risky, he will be margined by the exchange. So some example here. So someone holding a Reliance 1400 call, buyer and the holder, they mean the same thing. Means he has a right to buy 500 shares of Reliance. Why 500 shares? That is one lot in the FNO segment. So the buyer of Reliance 1400 call has the right to buy 500 Reliance shares at 1400 on expiry. So this is the nature of the contract. Similarly, the seller of the Reliance call will have an obligation to sell 500 shares of Reliance at 1400 when exercised at expiry. So this is how the contract would look like. Similarly, let's have a look at the put option. The buyer of a Reliance 1400 put option will have the right to sell 500 Reliance shares, that is one lot, at 1400 on expiry. And similarly, the seller of the Reliance 1400 put option has an obligation to buy 500 shares when exercised at expiry. So in a put option, the buyer will benefit when the Reliance price goes down. Suppose Reliance goes to 1200. The buyer still has a right to sell it at 1400 because he is holding on to this contract. From a seller's point of view, if Reliance moves from 1400 to 1200, he will lose about 200 rupees. But if Reliance goes to 1500, he will not make that 100 rupees. He will only get the premium which was collected by him, maybe 10 rupees or 15 rupees or whatever. So this is how the contracts work. When you're holding a long call position, you generally have a bullish position in the market. This position will become more and more valuable as the underlying market price increases. When you're holding a long put options, you're generally holding a bearish oriented position. They will become more and more valuable as the underlying market price decreases. Similarly, when you're holding a short call options, you have a mild to neutral to mildly bearish view on the market. They will become valuable as the underlying market decreases. And similarly, when you're holding a short put position, you do have a neutral to mildly bullish view on the market. The position will become more and more valuable as the underlying market price increases. This is just have a look at this table. So this is the difference between a call option buyer and a call option seller. The buyer pays the premium, the seller receives the premium. The buyer has a bullish view, the seller has a neutral to bearish view. Profits potentially unlimited for a buyer. For a seller, the profit is limited to the premium amount. The losses are limited for a buyer. For a call seller, the losses can be unlimited. Margins not required for a buyer. Seller will have to pay a margin. Uh, this is a put buyer and a put seller. The put buyer pays the premium. The put seller receives the premium. The put buyer has a bearish view. The put seller will have a neutral to bullish view on the market. Uh, Put buyer can make a large amount of money when the market goes down significantly. The put seller cannot make more than the premium amount. The put buyer losses will be limited. The put seller losses can be large if the market corrects badly. Put buyer will not be required to pay any margin, and the put seller will have to pay a margin. So this is how a long call looks like. So here is a trader who has bought the 900 call on SBI and he paid about 20 rupees. This is how his position will look like. If you watch carefully, below 900, he makes about a loss of 20 rupees. He can't lose more than 20 rupees on the trade. He will break even at 920. Why 920? Strike plus premium. And above 920, he can make potentially a large amount of money. So this is how a long call will look like. This is how a short call looks like. A trader who has shorted the 900 call at 20. Okay, so this is his profit. He can't make more than 20 rupees over here. He also breaks even at 920, and above 920, he is looking at potentially unlimited losses. Let's have a look at the long put. A trader has bought the 900 put at 20 rupees. Uh, Anything above 900, he will lose 20 rupees. He will break even at 880. Why 880? 900 minus the premium, and below 880 you can make potentially large amount of money. So this is how a long put looks like. And finally, this is how a short put looks like. uh, Here is a trader who has shorted the 900 put. He's received 20 rupees, so above 900 he will make 20 rupees. But should SBI correct sharply, he will lose a lot of money. You can see here. So he will also break even at 880, and anything below 880, uh, he's looking at huge losses. So this is the payoff profile of the long call, the long put, the short call, and the short put. In case of a long future and a short future, the payoff is symmetrical. It is unlimited profit, unlimited losses, both in case of a long future and in case of a short future. However, in options, the payoff is not symmetrical, as I have shown you. This is how a long call looks like. This is how a short call looks like. This is how a long put looks like, and this is how a short put looks like. Okay. So with that, we are coming to the end of the session. We have some 10-12 minutes with us. Okay. So I'm free to take questions. So whatever questions you have, you please go ahead.
Yes, sir. We have jotted down some questions from our participants.
Okay.
And the first question is from, I think, anonymous attendee. How do clearing corporations make money?
They collect fees. They collect fees from all the participants.
The second question is from Mr. Alok Bansal. He is asking, what is novation?
Novation is a process by which the clearing corporation becomes counterparty to each and every trade. So this is done in order to ensure that settlement takes place. When you and me trade in the exchange, for us, the counterparty is the clearing corporation, because that other party is anonymous. We do not know who is the other party. So novation is a process used by clearing corporations all over the world to settle trades.
Another question is from Mr. Puneet Reddy, sir, and he's just saying like, so if the contract is not respected by baker and farmer, there are no consequences? Question mark. I think he's talking about forward or future. It is not clear,
No,
sir.
in
You
a
may
in
speak
a
about.
forward contract, what will happen is you'll have to take the counterparty to the court, and it can drag on for years. In an exchange, everything will be settled immediately. You will not have to go to the court.
And one of the participants, Mr. Once, he is asking an ISM 8 paper, I think equity derivative, will
Yeah.
help in what way in future jobs?
Uh, if you get an opening in the financial markets where your firm trades derivatives on its own account, or they are, for example, broking firms or mutual funds, or domestic institutions or FIs or hedge funds, they all trade derivatives. So if you are getting an employment opportunity there, it will be mandatory for you to give those exams. So why not give it beforehand before joining those firms?
One other participant, Mr. Sandeep Yama, he's asking, why would one sell call or put options when there is limited money to make?
It has, Sandeep, it has got something to do with mathematics. Uh, so what happens is, this is the empirical data. Roughly 75% of the time, the option seller makes money. Okay. So I will go one step further and add, the smartest money in the market belongs to the option writers or the option sellers. They make money most of the times. Not that it is not risky, it is very risky, but Those who write options also have the skill to manage it.
One of our participants, Mr. Arun Kumar, he is asking which instrument is suitable for retail long-term investor for hedging purpose.
In derivatives, we do not have any long-term instruments. Okay, so you do have dated options, but they are not very liquid and they are quite expensive. Okay, and
An-
secondly, long-term, there is no such thing as a long-term hedge. When you trade the market, you generally hedge for one particular event. Because if you keep on hedging your position, there is no money to be made.
One of the query from Mr. Anish Modi, he is asking, can you explain how can one hedge against all odds in the economy?
That is for example, you're bearish on the market, you can short a future, you can buy a put option, you can short a call, right? You're bullish on the market, you can go long futures, you can go long call, you can, uh, you know, uh, short a put. Suppose you have a view like this: I am bearish this month and I'm bullish the next month. So what I can do is I can short current month call and go long on the next month call. So whatever you can think of, it is possible to design a product. That is the beauty of options.
Another question is from Mr. Pranil. He is asking, can you guide regarding covered call strategy?
Covered call is long underlying and a short call. It still remains one of the most popular derivative strategies all around the world. So if you have an underlying with you and you want to earn some rental income on that underlying, so what you do is you keep on writing out of the money calls. The idea is you are not planning to sell the underlying, so you're holding an underlying a good stock. So just keep on writing out of the far out of the money call and earn some income on that.
Mr. Amit Saha is asking, sir, selling option is the safest way to make money in
No,
derivatives?
no, no. You need to have the skill to manage it. It is dangerous.
Harshita Jaiswal is asking, what is the easiest way to remember long call, long put, and short put?
The easiest way to remember is you have to study it. Okay? So unless and until you study these instruments, it will be difficult for you to remember all that. So long call makes money on the upside, and on the downside, it loses only the premium amount. A long put makes money on the downside. On the upside, it will lose only the premium amount. A short call can lose money if the market goes up, and if the market goes down, you will get the premium amount. A short put will lose money if the market goes down, but you'll make money, that is a premium amount, when the market goes up. But I think that was Harshita, right?
Yeah.
Harshita, you'll have to revise all this. It is not so easy to remember. You'll have to go through the NISM, that series 8 book, where all of these are very nicely explained. Yeah, Ashutosh, you can go ahead.
Uh, Someone is asking, like, how can RR ratio influence making money? How much shall we usually plan to be profitable?
What
I
is an
think
RR ratio?
I think risk reward, maybe. I'm not sure, sir. He's talking about
The
Mr.
RR can
Vilas.
have, yeah, yeah. So just ask him uh, what exactly he means by RR ratio.
Mr. Vilas, you can type. Yeah, risk to reward, he is telling.
So when you uh, for options, it will be different, but generally for equity and futures, when you trade, so whatever risk you're carrying, you must make at least 1.5 to 2 times the loss. Okay, so this is a conservative estimate. Again, there is no general rule here. Uh, each trader is different. But if you ask me honestly, it should be, if you're taking a 2% risk, then you should be making at least 4 to 5% on the trade.
Kamal Wadhwani is asking, is options trading gambling?
Uh, no, I don't think so. If used properly, it's a lovely way of making money. But having said that, people use options trading as gambling. वो भी सच है. But it has to be used properly.
One of the anonymous attendees is asking, Sir, one general question. Even Sevi data says that more than 93% of traders are getting loss in the trading segment. So,
Yeah.
which would be safer option or future for beginners?
A beginner should never start with futures. That is, I would not never advise that. You can start with buying of options suitable to your risk, okay, depending on your view, because some of the out of the money options you may get it for 6,000, 7,000 total rupees. That is only risk you carry. Once you get more and more comfortable with the market and you know how the market, the price actions and all that, then and only then you get into selling of options. Please do not begin your career by becoming a seller of options. It is very dangerous.
Movin is asking, Sir, what is your view on current market with considering INR depression, dollar reserve, etc.?
Uh, it's not looking good, that is so for sure. But valuations are getting cheaper and cheaper. Hopefully, the market has become, in USD terms, it has become very cheap to foreign investors. Hopefully, at some point of time in the future, they will come back. Uh, we may have till such time a largely range bound market. I do not see a huge downside. Like if you tell me the market will go to 17,000, 18,000, my answer to that is unlikely. So market would remain range bound, probably with a mild negative bias.
One last question, sir, I think I will take from Shipra. She's asking, Sir, why is the long term call option have a bullish market?
No, who said long-term call option as a bullish market? There's nothing like that. It is a dated option which is available to you. So just like you have 1 month, 2 month, 3 month options available in Nifty, uh, you also have long-dated options up to 5 years. They are not very liquid, so you may probably get away with a few contracts here or there. But if you're a large institution and you want to trade 50 lots, 100 lots, it is not right now in India. It's not possible in the long-dated options. Long-dated options are there is nothing bullish or bearish about it. It is an instrument which is available to you for trading. That's all.
Thank you so much, sir, for
Thank you.
giving us the time to the participants and answering the questions one by one quickly.
Yeah.
So it's our time to help the participants to see our NISM certification and courses. So I'm just giving the tour of it.
Uh, Ashutosh, with your permission, can I log out?
Yes, sir. Please, sir. Please. Thank you so much again.
Thank you. Thank you, all of you.
Yeah, participants, can you see my screen?
Yes, we can.
So you can see NISM website. I'm just typing nism.ac.in. If you go to our website, and then on the top, you can see e-learning. When you click it, e-learning, you can have all the courses, like our help desk team details is also there from Monday to Friday, 9:30 a.m. to 1 p.m. and 2 p.m. to 5:30 p.m. Our help desk is available. You can call and ask. And if you want to explore yourself, you can click here on explore all courses. You can just type like equity derivatives. Then you can see like the course available with the name equity derivatives. It's like FDP program equity derivatives. This is for our partners like HEIs. You can click the view more and see about it. You can fill up the inquiry form. You can see the modules. You can see the FAQ details. Similarly, for other courses also, suppose you want to see equity derivatives, view more. And then you can have download brochure. If you click here, you will be able to download the brochure. You can check what's in it for you, module 1, module 2, module 3. And if you want for help, then FAQ is also there. And if you have some more question other than these FAQs, you can contact our help desk as well. We have NISM certifications as well. So if you go to our main website, NISM certification tab is there on the top. And after clicking certification examination, all the list of NISM certification examination is available. For example, if you'd like to see the equity derivatives, then here you can see equity derivatives. It's a duration 120 minutes, 100 maximum marks. Then 60% is passing, 25% is negative marking. Certificate validity is 3 years, and then fee is 1500 rupees. So accordingly, you can explore all the certification exams here. And if you want to explore any particular exam, for example, an SM Series 8 equity derivatives, after clicking it, you will see what are the examination objectives, what are the assessment structure, and all the study materials regarding NISM certification exam is free of cost available on our website. You can just click, fill up the details, and you will be able to see all the NISM certification examination workbooks. If you click here, for example, I would like to see the equity derivative certification examination. If we click view, we will be able to see NISM Series 8 equity derivative certification book. And if you want to download it, you can just click here and you will be able to download as well. So this is available free of cost and it is updated, and we update quarterly. So the participants, I think we should call it for the day. It's already 17 2. So thank you so much for attending the session, and you can reach an ISM by writing to us, and you'll be able to explore our website. I help you to see e-learning and an ISM certification as well. So Mr. Sri Ganesh, I would like to take your help to call the session.